There we go. Well, good afternoon, everyone. My name is Jason Graham. I'm the Regional Vice President for Columbus Life here in the state of Florida. It's an honor to be on here with Alex as a part of the Alpine Brokerage Group. We have a great, strategic partnership with the organization, with Dan and Josh and Alex here at the helm. And felt like this would be a great opportunity to kind of showcase a little bit about, one of the many products that we have to offer through Columbus Life that you actually have access to through Alpine Brokerage Group. So we talk about, a raise of hands. Obviously, we're virtually and everything like that. But a raise of hands is how many cases that you've come across in your lifetime that came back uninsurable. When I've done this presentation before, I have the whole room raising their hands up. And so what we did in this particular situation is we took a situation where the client was uninsurable and there was a real need that they needed coverage, and we figured out a way how we could do this. And at the end of the day, I think as agents, as advisors, we're always about staying in the sandbox, stay with what we know and everything like that. But sometimes in certain situations, it just doesn't work. And so we've got to start thinking outside of the box a little bit. So what I'm going to do is talk a little bit about our survivorship product, which is an indexed universal life product. And those that are not familiar with second to die or survivorship products, it's basically a policy that you're insuring 2 lives on. And ultimately the death benefit gets paid out, not at the first death, but at the second death. Now, there are some carriers out there that have some riders that will do that. Ours doesn't do that. But for this purposes, we'll show you how we can synthetically create a death benefit at first death, and we'll go through that a little bit. Just also a little plug for Columbus Life. We're a mutual holding company based in Cincinnati, Ohio, where we are under the Western and Southern Financial Group, which is also a mutual company. So we only answer to policyholders. Our capital all comes from the premium dollars that come into our company from our policyholders. So we're always in the best interest in terms of the policyholder when it comes to products and support that we offer to you and to the agent, to your clients. So, all right, let's get into this and talk a little bit about this particular case study. So this was about probably like 4 or 5 months ago. I had an agent that came to me looking for a policy with us and gave me some particulars about this particular client. So this woman, female, was age 52, great health, height-wise, height, build, everything else was great. The only thing that came up was she had stage 4 breast cancer. And she's been treated for it. She's been cancer-free for almost 2 years. To cover for that cost of the treatment, she actually did have life insurance policies out there, and she ended up cashing those out to help to cover for the treatment that she needed to do to obviously get rid of the cancer and potentially future flare-ups that could come up at some point. So she like anything, when we work with our clients, when these situations happen, obviously now a lot of policies have these living benefit riders that would be able to cover for that. In these particular situations, these policies did not have them. So the only best thing that she could do is cash these policies out to do that. So the agent was like, well, what do you think? What can we do? What does the underwriters think on this? And it wasn't just us. It was other carriers that they were looking at as well, too. And so when we presented the findings and the situations, most of the carriers, including us, came back, we're not willing to offer any coverage for the next 4 to 8 years. And at that point, it's going to be highly rated. And there could be a per thousand cost that would be assigned to that. So obviously, from the agent's perspective, he kind of felt like, well, we're hitting a dead end. Like, it doesn't look like anything that we can really do to really help out this particular client and everything like that. But some things came up from the discussion with the client. She did remarry 4 years ago, so she has a husband who's same age as her, is in really good health. He's a surgeon, so he does pretty well. And she does have children from a previous marriage, 2, in fact. And the oldest one, I believe, is going to be a freshman in high school. And the other one is an adult, an adult living on their own and everything like that. And really why she was looking at life insurance again is that she really just wanted to leave something behind to them, for them and them alone. And the dollar amount was $250,000. She wanted to be able to leave $250,000 to her children if something were to happen to her. Because obviously, these things happen. When a particular when an individual has a situation where if it's almost life-threatening, that they are now like, well, man, I really need to do something to protect my kids. And unfortunately, a lot of times it's too little, too late, because whatever particular ailment that they have, they unfortunately are probably not going to be able to get covered because of the history of it and what we see from a life expectancy perspective. So all of this was lined up to like, well, there's really nothing that can be done with the client. But, like anything else, we've got to get creative. And so, what we did is we took a look at an opportunity where we can supplement, potentially a solution using our survivorship policy. So this is basically the first page of the actual illustration. So if a lot of you are familiar or not familiar with survivorship or second to die, is that most carriers, including us, do allow one uninsurable on the policy. As long as we feel life expectancy wise they're going to make it past a year, we can put them on the policy. And then we can add another insured on the contract, and they can be no worse than the table H with us. We can actually do the policy. Now, remind you, obviously, with the death benefit doesn't get paid out at first death. It gets paid out at the second death. So, obviously going into this, we had this discussion and let them know that. The wife has a PhD, highly educated, does very well, works in the education field. So she does very well from a financial perspective. So we basically position this in one of two ways in terms of the ownership of the contract. She can either own it outright, or she can set up a revocable trust where she is the owner, she is the trustee and the grantor of that trust. And the reason for the trust is we don't know, like if she does pass away first, like if the husband would, honor her wishes to take care of her kids in some form or fashion, let alone, getting access to the policy to pay for the kids. And so we didn't want to put a situation where the kids were not being taken care of. So like putting a revocable trust in place makes a lot of sense. There's not in a taxable estate, so there's no problem with that with regards to the policy having an impact from an estate tax perspective. But the revocable trust actually created making assurance that her wishes would be taken care of. Something were to happen to her if she did pass away first, so that the husband would be have to honor the wishes that were in place with that. So you can see from this illustration, we did a couple of things. One is that the client is paying $15,000 a year. I believe it's for 15 years into the contract. We'll go to the next slide to show that. We had a death benefit of $250,000. We're doing an increasing death benefit. We're doing an increasing death benefit till the last premium payment on the contract, and then we're leveling it out to a level death benefit. So you can see they're putting 15 in a year for 10 years, and then we'll go to the next page here, and we'll see like at age, paid it to age 65. You can see they put in $195,000, and then we've obviously leveled out the death benefit at that point. So here is the alternative solution for her. So you can see at age 70, let's just assume her life expectancy, she passes away, the cancer came back, it was aggressive, and she passes away at age 70. So what we have basically, she could do with this policy, with the trust owning it, is that the policy could take out $250,000. And remember, because the policy is not a MEC, that money is coming out tax-free. So that money would then go into the trust, and then the trust would then disperse that $250,000 to the trust beneficiaries, which in this case would be her son and her daughter. And it leaves a little over $80,000 in cash value, and the death benefit is just shy, is about $250,000. The policy does actually stay in force to age 120 based on doing this. Okay. So there, the policy's not lapsing, but remember, we do have an overloan protection rider so that if it, the policy is overborrowed, for 15 years up to age 75, that even if it does implode, there's not going to be a taxable event, from the husband's perspective. So this was option, this is the alternative option. Is it better than an individual policy? Not necessarily, but we're still putting money into a policy that is giving her that tax-free distribution that would get paid out if something were to happen to her. So a lot of people are like, okay, I put 195, pulled 250 out. Like, couldn't I just put that in an investment? Could I put that in an annuity instead? Which you could, but you wouldn't necessarily have the tax benefits. So let's take a look from a numbers perspective. So if you're looking at year 20, based on everything that's been put into the contract, what was taken out at year 20, in order to do what we're showing here, you would have to have an asset that is paying tax on a tax-free basis, 4.66% for 20 years each and every year. Last time I checked, I don't think there's any annuities out there that they're offering 4.66% each year guaranteed for 20 years. I just don't see it out there. Obviously, you can do, you can buy a bond. Bonds are going to go up and down. But the next best thing would be investing it. Well, again, from an investment perspective, you're going to ride the ups and downs of whatever the market does. Obviously, you can balance it with the allocation and so forth. But at the end of the day, this is giving you the client's getting a good rate of return on their money, but also they're getting the tax favorable treatment by pulling the money out of the contract to be able to pay, to the beneficiaries if something were to happen to her. So, she liked this idea. The agent liked this idea because, again, it's not the next best thing, but it is giving her the control that she needs with the policy, but also knows that something happens to her first off, even though the death benefit doesn't get paid out at first death, that there's enough cash in this contract that the trust could borrow against it, tax-free, go into the trust, and then pay out to the remaining beneficiaries. So hopefully that makes a lot of sense. And if you have additional questions, obviously, Alex and I can help you with that. But there is one additional thing that came up that was kind of like a cherry on top on this deal. And I was not aware of it until I went back to Columbus and asked them this particular question. And because the way that it was illustrating, and that it could add an additional benefit that she had no idea that was available. So let's assume that she outlives him, which, again, most people do realize that from time to time. Most of the time that women tend to outlive men, and that's possible. Even though with the cancer diagnosis, men could, have a heart attack or whatever that may be. So, if he passes away, obviously there's not a need for a death benefit to be paid out at this point, or let alone pull money out of the contract. So, what's this hidden benefit that I'm alluding to with this? Well, our survivorship product has a living benefit rider on the contract. It's available on the surviving spouse, and that covers for specified medical condition. It covers for chronic illness, and it covers for terminal illness. So specified medical condition is basically critical illness, and then chronic illness, 2 out of 6 ADLs without, verified by a healthcare practitioner. If they have a chronic illness, they will be able to accelerate the death benefit, and then terminal illness is also the same. But what's interesting with our company, with our product, and how our rider is designed is, even though she is uninsurable, the husband being preferred, this rider is actually available for her. So think about that. There's a lot of carriers out there, and I've ran some numbers that if one of the insureds is uninsurable and the other one is preferred, they do not allow their living benefits rider on there. They may allow for terminal illness, but they will not allow for critical or chronic illness. So this actually gave us an additional benefit that she can utilize, particularly the chronic illness side, because remember, she had stage 4 breast cancer. The chance that cancer could come back is very real. And if she does outlive her husband, now she has the ability that she can accelerate the death benefit to cover for her care if she were to go, have that cancer come back and it would be more aggressive and so forth. And so again, having this rider on here is very powerful because now she doesn't have to cash out the policy. She can actually accelerate the death benefit, and it'd be on a tax favorable basis, and she could use those funds to basically take care of her her treatment and so forth, and wouldn't have to worry about her kids having to worry about that. So takeaways. One is, with our survivorship policy, we actually showed her an alternative solution. And really, the main solution was a legacy that she could leave behind by her children. But because of the living benefit rider, we actually created an additional pool of money if her cancer comes back and she outlived her husband. So again, 2 for the price of 1, being uninsurable, that's pretty powerful stuff there. Secondly, if those that have been in the business long enough understand that with survivorship or second to die policies, these policies are typically done for people that have an estate tax problem. Well, as a lot of you know, the estate tax limits are pretty high right now. So there's not a lot of people that we deal with on a day-to-day basis that are having an estate tax problem. Now, obviously, that's going to change going into 2026, but those limits are going to come down, but they're not going to be as low as they were, in the early 2000s, where it was like $1 million or $2 million or stuff like that. But this also opens the opportunity that these survivorship products, these second to die products, can be used in different ways than just for estate tax purposes. And it's about getting out of the sandbox and being creative in terms of what you can do for your clients. And again, just hitting on the point, we've got to start thinking outside of the box. No better time right now in our industry is right now. If you think back in the 80s, early 80s, you really only had 2 products. You had term and whole life. Now you've got universal life, IUL, current assumption UL, survivorship IUL, VUL, whole life. You've got a gamut of so many different life products that are out there that it's all about now thinking about the solution and how can we get to a solution that works for the clients. And sometimes, because of their health, their situation is going to dictate where you may have to pivot elsewhere. And again, that's why you should consider second to die or survivorship, particularly with Columbus Life, because of our transparency, our cost structure, what we do, we say we do, and the integrity of how we keep our policies, our caps and our floors and our costs, across the board, the same, regardless if you are a client for the first time with us, or you've been a client with us for 10 or 15 years. So powerful stuff there to think about. Also, some other things to keep in mind, and we've got pieces for this. I've sent these over to Alex, and you're more than welcome. Alex is more than welcome to pass them along to you. Yeah. But there's some other ideas that you can use, and we'll just touch on them real quickly. First one is we like to call late to the party LIRP, where you can use our survivorship IUL policy for older age clients that like the idea of using the LIRP strategy, the life insurance retirement plan, and this really shows how the second to die would look versus like our individual policies, and the power that it could have in terms of really using it for retirement income. Next one is using it for legacy purposes. Obviously there's annuities that are being placed out there because interest rates are high and so forth. And a lot of times people don't use life insurance because of the underwriting perspective or because of the health of the client. Remember though, with our survivorship, we can take one uninsurable and the other one can be no worse than a table H. So if there is legacy in mind and there's no need for the money, looking at doing a single pay into our survivorship policy is great. Even though it's a MEC, the death benefit is still income tax free to the beneficiaries. So when you're leveraging 2 lives, it actually is going to create more of a benefit that's going to be available upon the death of both insureds on there. So again, another thing to consider. This other piece is kind of a variation on those that may have an estate tax problem, but they want to keep the control, the liquidity use and control that you lose if you put these policies in an ILET. The use of a survivorship standby trust is a way where clients can kind of have their cake and eat it too, using our survivorship policy. And that flyer will talk a little bit more about where it's going to create more options for your clients, particularly if they're on the fence about estate planning or estate taxes and want to be able to control it from start to finish. And then finally, we've actually created this piece recently where you could use survivorship IUL as a multi-generational asset. And in this piece, it's going to talk about how a father and an adult son use this policy where they split up the funding arrangements, but then they also split up the time where money could be pulled out for dad's retirement, but then also start pulling monies out from the son's retirement when the dad is long gone. So again, these are some great pieces that Alex can pass along to you to learn a little bit more about this. By all means, feel free to reach out to Alex or myself to learn a little bit more about this. And that's pretty much it. So I'd like to say thank you for your time today. I look forward to working with you all at Alpine. And please, if there's anything else we can do for you, please let us know, and we'll go from there. So, Alex, do you have any questions or anything that you want to, or any comments you want to add or anything like that?
No, I just, yeah, this seemed really helpful for me. I mean, I know that, we deal with agents a lot of times who are interacting with clients who are uninsurable for one reason or another. And so this gives them an option. But to your point about the living benefits rider, as you and I were preparing for this, I mean, I shot you an email that said, hey, I'm assuming there's no living benefit available on this, given that, there's a person sort of tagging along on the policy that's uninsurable. And, you came back and said, nope, we have it. And so it's there and it's a great benefit. So I think this was good.
Absolutely. Good. Excellent. Well, like I said, I appreciate your time doing this, and hopefully this is something that really resonates with you guys and with your agents. And if we need to do another live one, like if there's some more interest and they want to do more of a live one and do some follow-up questions and everything like that, we can definitely do that as well too. You guys just let me know. So
absolutely, we'll do.
All right, cool, perfect.
All right,
I appreciate it, Alex. Enjoy the rest of your week. Give my best to Dan, and I will talk to you guys soon. Okay.
All right, sounds good.
All right, take care.